As of Saturday, April 25, 2026, the market is closed for the weekend. Lucid Group Inc., LCID, finished the trading week on Friday, April 24, at a price of $6.25, seeing a slight intraday dip of about 0.32% following a week of intense volatility. While a price around $6 might look like a stabilize and hold scenario, the reality of what's happening behind the scenes at Lucid right now is a complete departure from the typical electric vehicle narrative. Most investors are staring at the stock price and waiting for a rebound based on vehicle deliveries. But the actual tension here isn't just about how many cars are rolling off the line in Arizona. It's about a massive structural shift in how Lucid is being used as a pawn in a much larger global autonomous network. The expectation for Lucid has always been that it would eventually become the Tesla of luxury, a high-margin manufacturer that could survive on the prestige of its engineering alone. But the reality is that Lucid is rapidly transitioning into a specialized technology provider for others. The recent capital raise of $1.05 billion, which includes a heavy commitment from Uber and the Saudi Public Investment Fund, tells us that the market isn't valuing Lucid as a standalone car company anymore. Instead, it's being priced as a high-tech R&D lab for the Uber robotaxi fleet. When you look at Lucid stock through that lens, the $6.25 price point starts to look less like a failing car maker and more like a high-risk bet on the future of autonomous logistics. This is a massive expectation versus reality gap that most retail investors are missing while they focus on quarterly delivery misses. The trading volume on LCID has been explosive lately, often hitting triple its daily average as institutional players reshuffle their positions following the announcement of the 35,000 vehicle robotaxi deal. It's a strange sight to see a company hit a 52-week low and yet receive such massive institutional backing from one of the world's largest sovereign wealth funds. Usually, when a stock sits at these levels, you see an exodus. Instead, we're seeing a consolidation of power. If you're using platforms like Robinhood or the SoFi trading platform to track these movements, you've likely seen the alerts regarding Lucid's volatility. The heavy sell-side pressure we saw earlier this week, which dragged the stock down from the $7 range, was driven by a pre-announced revenue miss where the company admitted they are only bringing in about $280 million against expectations of over $430 million. That is a staggering gap, and it's the primary reason for the bearish sentiment currently suffocating the ticker. Institutional activity suggests that while retail is fearful, the smart money is looking at the long-term infrastructure. If you look at Interactive Brokers or Fidelity brokerage data, the short interest on Lucid remains high, creating a persistent drag on any upward momentum. Traders are betting against the company's ability to manage its cash burn, which currently sits at an operating loss near $1 billion per quarter. That is the reality that is winning right now. The expectation was that the Lucid Gravity SUV would be the savior, but a 29-day production halt due to seat supplier issues early this year proved that manufacturing at scale is still Lucid's Achilles heel. Even though they've reaffirmed their goal of 25,000 to 27,000 vehicles for the year, the market has stopped giving them the benefit of the doubt. This brings up a crucial question for anyone looking for investment help or exploring online investing options. Are you buying a car company or a tech licensing play? Lucid's proprietary motor and battery tech are arguably the best in the world, which is why Uber is willing to sink hundreds of millions into them despite the stock's poor performance. They aren't buying the stock because they think Lucid will sell 1 million Air sedans. They're buying it because they want the efficiency of Lucid's drivetrain for their autonomous future. This creates a floor for the company that wouldn't exist for a traditional manufacturer. If you're managing your own assets through Schwab Intelligent Portfolios or self-investing through a Fidelity IRA, you have to weigh that floor against the constant threat of dilution. Every time the Saudi PIF or Uber steps in with more cash, more shares enter the supply, making it harder for the price per share to actually move higher. The broader macroeconomic environment is also putting a ceiling on LCID. High interest rates have made luxury EV purchases a tough sell for the average consumer, and the higher-for-longer stance from the Fed has increased the cost of capital for a company that desperately needs it. This is why we see such a divergence between Nvidia stock, which is riding a wave of immediate profitability, and Lucid stock, which is essentially a call option on a decade-long plan. Even Apple stock, which faces its own growth challenges, has a fortress balance sheet that Lucid can only dream of. For someone looking to invest online, the contrast is sharp. Lucid is a battleground stock where the bulls point to the technology and the bears point to the bank account. Comment below how many shares of Lucid Group you currently hold, and tell me if you think the Saudi PIF will eventually just take this company private to end the public market headaches. When we look at the business model, Lucid operates as an integrated manufacturer. They do everything from the battery pack design to the software in-house. This compromise-nothing approach is what won them the 2026 World Luxury Car of the Year award for the Gravity SUV. However, that level of vertical integration is expensive. It's the same reason they have a debt-to-equity ratio that many conservative analysts at firms like Fidelity Wealth Management or Schwab uneasy. Their gross profit margin is currently deep in the negative, meaning they lose a significant amount of money on every vehicle they deliver. The transition from a low-volume boutique maker to a mass-market player is where most EV startups die, and Lucid is currently in the valley of death between those 2 points. The upcoming Q1 2026 earnings call on May 5th is the next big catalyst. Expectations are incredibly low, which is sometimes a good thing for a stock price. If management can show a path towards narrowing those losses or provide more concrete details on the midsize platform, which is supposed to start under $50,000, we might see a relief rally. The midsize platform is the reality that needs to exceed expectations. Right now, the public thinks Lucid can only build $100,000 cars for celebrities. If they can prove they can build a $45,000 SUV that gets 400 miles of range, the entire valuation model for the stock changes overnight. For the active trader using the Robinhood app or the Fidelity mobile app, the technicals are looking grim but oversold. The stock is trading well below its 50-day and 200-day moving averages. Usually, when a stock is this disconnected from its long-term trend lines, you see a snapback effect. However, that requires a reason for people to buy. Right now, the only reason people are buying is the take-private speculation. There is a persistent rumor that the Saudi PIF is tired of the quarterly transparency requirements and the constant short-selling attacks, and that they may offer a premium to buy out the remaining shareholders. This expectation keeps the stock from falling to zero, but it also creates a stagnant trading environment where the stock just drifts sideways. If you're looking at online investing sites or seeking investment help, you'll see that the consensus rating on Lucid has dropped to a reduce or hold at best. Most analysts have slashed their price targets from the $15 range down to $8 or $10. This reflects a lack of confidence in the near-term delivery numbers. The reality is that Lucid's technology is ahead of its time, but its business execution is lagging behind. They have the best engine, but the factory is still being tuned. For an individual brokerage account holder, this is the ultimate test of patience versus opportunity cost. Is your money better off in a diversified basket of Fidelity ETFs or a steady performer like Apple stock? Or are you willing to sit through the volatility of a startup that could be the backbone of the world's largest robotaxi network? As we look toward the end of 2026, the catalysts are clear. We need to see the Gravity SUV reach full production capacity without more supplier glitches. We need to see the first 5,000 vehicles delivered to Uber for their San Francisco pilot program. And most importantly, we need to see a stabilization in cash burn. If Lucid can bridge the gap to their midsize platform without another massive dilutive share offering, they might finally break the cycle of lower highs and lower lows. But if the Q1 earnings show that the $1 billion in new capital is already being eaten up by operational inefficiencies, the reality will once again fall short of the market's dwindling expectations. Lucid remains a high-conviction play for those who believe that engineering superiority eventually wins the market. The stock movement we saw today and throughout this week is a reminder that the transition to electric and autonomous transport is not a straight line. It is a messy, capital-intensive, and often painful process for shareholders. The contrast between the award-winning quality of the vehicles and the struggling performance of the stock is one of the most significant gaps in the current market. Whether you use SoFi Invest, Interactive Brokers, or a traditional Fidelity brokerage account, the key with Lucid is understanding that you aren't just buying a stock, you're funding a pivot in global transportation. In summary, the expectations for Lucid were built on a foundation of luxury sales that haven't quite materialized at the scale needed to sustain the business. The reality, however, is a company that has successfully pivoted into a strategic tech partner for the future of mobility, backed by some of the deepest pockets on the planet. This creates a unique tension where the stock price is punished for today's losses, while the company's tech is valued for tomorrow's infrastructure. It's a classic high-stakes scenario that requires a clear-eyed look at the data rather than the hype. Stay grounded, keep an eye on those delivery numbers, and remember that in the world of investing, the loudest narrative is rarely the most accurate one. Lucid Gravity, 2026 World Luxury Car of the Year. This video provides an in-depth look at the Lucid Gravity, the vehicle that is central to the company's 2026 recovery plan and its critical role in the luxury SUV market. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Share with your friends. Bell, subscribe for more updates.